In this section, I will discuss bonds. So, what's a bond? A bond is a contract that specifies that a borrower owes a certain sum and the dates at which the interest and the principal will be paid. So, for example, consider a 5-year bond with a face value of $1,000 and a coupon rate of 5%. Let's say, for the moment, that this is an annual bond. What that means is that 5% of that $1,000 will be paid every year, that's what's called the coupon payment, with the $1,000 paid at the end. Why are those payments, which in this case are $50, called coupon payments? So it used to be that when you held a bond, you actually received a certificate. And that certificate came with coupons that you would tear off and mail in and receive, in this case, your $50. So that doesn't happen anymore, but we still call those payments the coupon payments. So we're going to proceed to value bonds in several steps. The first type of bonds we're going to value are called zero coupon bonds. So that sounds complicated, but in fact, these are the simplest kind of bonds. We can think of them as the elementary particles of finance. What these bonds are a fixed payment at a certain number of years in the future. They're called zero coupon bonds because the coupon rate is zero. They have no intermediate payments. Do such bonds actually trade? Yes, they do. And in fact, they have a funny name. They are sometimes called strips. Because what bond dealers do is they take a coupon bond, because virtually all bonds are issued as coupon bonds, and they, so to speak, strip off the coupon payments and sell them separately. And they also strip off the principal payment. That's why these zero coupon bonds are sometimes called strips. They are sometimes also called discount bonds because as long as the interest rate is greater than zero, they will sell at a discount. After we discuss zero coupon bonds and their pricing, we will talk about the returns on these bonds. An alternative name for a bond is a fixed income security. So going back to my first example, that bond had a fixed income of $50 a year. One thing that we will see, though, is that even though bonds are fixed income securities, they're not fixed return securities. So even for a zero coupon bond, the return may not actually be fixed. So we'll review the distinction between yield to maturity and return on a zero coupon bond. From there, we will move on to the valuation of coupon bonds and to returns on coupon bonds. Then there's another wrinkle. In fact, almost all bonds are issued not as annual bonds, but as semi-annual bonds. So we'll briefly discuss what wrinkle that introduces into the pricing. Then last of all, we will talk about something called the yield curve, namely how yields on bonds relate to the maturity of the bond. Okay, so we're going to start by talking about the simplest kind of bond. A simplest kind of bond sets the coupon payment to equal zero. So the coupon rate is equal to zero. And so what we have is called a zero coupon bond. And the zero coupon bond has a fixed payment at maturity and nothing else. You can think about zero coupon bonds as the basic building blocks of all other kinds of securities, because it's really the simplest kind of security you could ever think of. You know with certainty what you're going to get, and you only have a single payment. So let's think about a bond that has a face value of $1,000 a maturity of 5 years, and also that the interest rate is 7%. What's the price of this bond? Well, we're going to use present value. So we take our face value and we discount it back 5 years at an interest rate of 7%. That gives us $712.99. Now, why is this bond worth $712.99? Is it just because the formula says it should be worth that? Well, no. It all comes down to the fact that this R is 7%, which is telling us the time value of money. If, for example, the price were bigger than $712.99, presumably nobody would buy the bond. You would earn more putting your money in for 5 years in the bank. And if the price was less than $712.99, everybody would be trying to buy the bond, perhaps using borrowed money. And in either case, the bond dealers would be forced to adjust the price to maintain their inventory. So market forces are what's going to send this price back to be $712.99. Okay, so now let's think about this example a little bit more. Again, we'll keep the interest rate R at 7%. So if we have a maturity of 5 years, the price is $712.99. If instead the maturity is 3 years, well, we can do the same present value calculation. It's, by the way, 1,000 over 1.07 cubed, and that gives us $816.30. Now, the thing about bonds is we can see these numbers as two different bonds at the same point in time. So at a single point in time, there might be a 5-year bond and a 3-year bond, or the same bond at two different points in time. So the 5-year bond selling for a price of $712.99, assuming market conditions don't change, 2 years later becomes a bond selling for $816.30. Then 3 years after that, so of a maturity of 0 years, the bond, of course, is going to be worth its face value of $1,000. So some people call this process that the bond is being pulled to par, par being another word for face value. So the idea is that there's a force pulling the bond price to its par value of $1,000. Well, that force is really nothing other than the time value of money. So now let's ask a different question. Given a price, and of course a face value, what R makes this price correct? So let's say we start with a price of $712.99. So now we can solve for R. Well, we get price equals face value discounted back, in this case by 5 years. So $712.99 equals $1,000 over 1 plus R to the 5th. Well, that implies that we already know R equals 7%. In general, we can solve for R. P equals F over 1 plus R to the T. Doing a bit of algebra, P times 1 plus R to the T equals F. 1 plus R to the T equals F over P. And finally, R equals F over P to the 1 over T minus 1. When we solve for the R that makes the price equal to the present value, that R has a specific name. This is called the yield to maturity. Bond investors frequently use the yield to maturity as a way of evaluating the investment. We want to look closely at this practice. We're going to ask, what is the rate of return you actually earn on a bond, and how does it relate to the yield to maturity? Well, first, we're going to ask, what is a return? What does it mean to have a return? What is a return? This is going to sound kind of abstract and philosophical, but it will get concrete. So let's say you have an investment with value V. One possible definition of return is the percent change in your investment. In that case, R is VT, so your value at some time T, minus the value you started with, value 0, divided by value 0. That's the percent change. And we can rewrite this as VT over V0 minus 1. So let's think about that definition of return as applied to our 5-year bond from the previous clip. So remember, this 5-year bond has a face value of $1,000 and a price of $712.99. So let's say we take this bond and we hold it to maturity. In that case, your VT is your $1,000. Your V0 is the price you paid. So R is VT over V0 minus 1. Well, that's 1,000 over 712 minus 1, or 40.25%. Very nice. Now let's think about the 3-year bond. Same face value, and keep in mind, same yield to maturity, but the price of this bond is $816.30. Well, now, if we take the percent change in value, we get 1,000 over 816.30 minus 1. Well, that's 22.05%. Wait a second. Does that make sense? Should the return on the 5-year bond be bigger than the 3-year bond? We're missing something here. And what we're missing is that it took you 5 years to earn this 40% on the 5-year bond, whereas it only took you 3 years to earn the 22%. So somehow we need to adjust for the length of time that you're holding the investment. Well, there's a simple way to do that. And if you'll remember from our discussion of effective annual rates, we do basically the same thing. We annualize the investment. Let's see how this works. So we want to find R such that 1 plus R to the T, this T is how long you hold the investment for, is equal to how much you actually earn. That's VT over V0. So in other words, R is equal to VT over V0 to the 1 over T minus 1. We will sometimes call this the holding period return. holding period return, or HPR. We might also call it the annual return, depending on the setting. Note that we're calling it the holding period return because it's the return that you actually earn when you hold the investment. And it's the annual return because we've annualized it. Let's return to our bond example. With our good old 5-year bond, now we're taking 1,000 over 712.99, and we're annualizing. So that gives us a holding period return of 7%. The 3-year, let's do the same thing. Now we're annualizing by dividing by 1/3. You'll find that again, it's 7%. Now this is more reasonable. So this, by the way, as I mentioned before, these calculations are holding period return. Now you might notice something else. This holding period return is equal to the yield to maturity. Well, that's a general result. So recall our definition of yield to maturity, which says that the yield to maturity is the discount rate that makes the present value of the payments equal to the price. For a bond with 0 coupons, that gives us the face value over 1 plus the yield to maturity to the T, let's say T is the maturity, equals the price. So here this T is maturity. In other words, the YTM is F divided by P to the 1 over T minus 1. Well, let's look at this formula. This is the same formula as for holding period return, provided that VT is F and V0 is P. This is equal to the holding period return if you hold the bond to maturity. Let's just plug in. F is our VT, P is our V0, everything else is the same. So we have the following result. For a 0 coupon bond, the yield to maturity equals the holding period return if the bond is held to maturity. So in this case, the yield to maturity really did measure the holding period return. Notice, though, there's 2 provisos here. The first is that the bond is held to maturity. The second is that it's a 0 coupon bond. So let's just briefly go through an example when the bond is not held to maturity and just see what could happen. Okay, we're going to do an example where we don't hold a bond to maturity. We have a 10-year bond. It's a 0 coupon bond. The face value of the bond is $1,000. The price of the bond is $450.11. By the way, that implies that the yield to maturity on the bond is .31%. So and what I'm going to ask is, what happens if you purchase this 10-year bond and sell it after 1 year? So after 1 year, the bond is a 9-year bond. Now let's just say that market conditions have changed. So here we are 1 year later. Market conditions have changed and yields are higher. So now the yield to maturity on the bond is equal to 8.6%. That means that the bond is selling for a price of 1,000 over 1.086 to the 9. It's a 9-year bond. Or $475.92. So between when you bought the bond and when you sold it, the yield rose. So what do we think this means for the holding period return? Remember, holding period return is VT over V0. Now we're talking about a 1-year investment. So there's no 1 over T. Minus 1. So when we sold the bond, it was a 9-year bond. We sold it for $475.92. We bought the bond for $450.11. Our holding period return is thus 5.7%. It's not the yield to maturity when we bought the bond. So this 5.7% is less than our yield to maturity of 8.31. This 5.7% is less than our yield to maturity of 8.31%. Okay, so our holding period return is less than our yield to maturity. So in this example, we saw that the yields rose and our holding period return is less than the yield to maturity. If yields rise, what happens is you basically get a loss on the bond. Your holding period return is less than your yield to maturity. If yields fall, and in the notes there's an example like that, the holding period return is greater than the yield to maturity. If yields stay the same, no surprise, holding period return equals the yield to maturity. But what do we conclude from this? What we conclude is that bonds are not risk-free investments. Bonds are fixed income. That's why we call them fixed income securities, not fixed return. So when is the bond a risk-free return? Only in one situation. When your holding period matches exactly the maturity of the bond. So in the previous clip, we talked about valuing zero coupon bonds, the basic building blocks. It so happens that governments and corporations issue coupon bonds. And so do individuals, actually, mortgages being a form of coupon bonds. So we need to know how to value coupon bonds. So let's start by writing out the cash flows on a coupon bond that might be issued by a corporation or by a sovereign government. Okay, so times 0, you don't get anything. When we're valuing a security, we always assume that the cash flows start 1 year later. So you get, in the first year, a coupon of C. You get, in the second year, a coupon of C. In the third year, you get a coupon of C. In the fourth year, you get a coupon of C, and so on and so forth until the maturity of the bond when you get another coupon and the face or par value. So there we have the cash flows for a coupon bond. And we know how to value them. The price on this coupon bond is C over 1 plus R plus C over 1 plus R squared plus dot, dot, dot plus C plus F over 1 plus R to the T. So there are two distinct rates associated with coupon bonds. The first is the coupon rate. Which is the coupon payment divided by the face value. The next is our old friend, yield to maturity. What's the yield to maturity? It's got the same definition as for a zero coupon bond, but the formula for the zero coupon bond isn't going to apply anymore. The yield to maturity is the rate such that the present value of the bond's payments equals the price. That's it. So I'm going to write out again the formula for the price of the bond. This R and of course same R here and same R here. This R, that is my yield to maturity because we're discounting the payments and making them equal to the price. So here's a good result for coupon bonds. The bond sells for its face value, sometimes called its par value, if and only if YTM equals C over F. So bond sells for its face value. That means the price equals the face value. That is true if and only if the yield to maturity equals the coupon rate. Why? Let's look at an example. I think you'll understand why it's true intuitively. So we're going to consider a bond with a 4% coupon rate and a face value of $100. So let's look at the cash flows of this bond. So you get $4, $4, $4, and then $104. So the price is equal to 4 over 1 plus R plus 4 over 1 plus R squared plus 4 over 1 plus R cubed plus 104 over 1 plus R to the fourth. Now, here's my claim. When this R is 4%, this price equals $100. You can prove that algebraically. But think about it for a moment intuitively. Suppose the interest rate is 4%. Now, somebody wants to borrow money from you, and this person is going to pay you the interest every year, and then the principal back at the end. I think it makes sense that the value of that asset to you would be $100. Namely, you're getting your interest payment in the form of the coupons. So the coupons here exactly offset the time value of money. And so in the end, you're willing to pay the face value of $100. So if P equals F, YTM equals the coupon rate. Basic results about bonds. Now, in general, we can look at the present value formula and see that the price is a decreasing function of R. Makes sense? R is in the denominator. We know for the R equal to the coupon rate, the price is equal to the face value. But yields on bonds fluctuate. Sometimes we're going to be over here. When we're over in this part of the graph, the bond is going to be here. The bond sells at a discount. Or we could be over here, and then we're in this part of the graph. The bond sells at a premium. To recap, when R, which is the yield to maturity, by the way, when the yield to maturity exceeds the coupon rate, the price is less than the face value. Bond sells at a discount. When the yield to maturity is less than the coupon rate, the price is greater than the face value, bond sells at a premium. And when the yield to maturity is equal to the coupon rate, the price equals the face value, and the bond sells at par. Coupon rate, face value. When do bonds sell at par? When they are first issued. Bonds are typically issued at par. So the government or the corporation will choose the coupon rate equal to the prevailing yield to maturity. Then, over the course of the bond's lifetime, yields will fluctuate, and sometimes bonds will sell at a discount, and sometimes they will sell at a premium. So we define the yield to maturity for a coupon bond as the rate that makes the present value of the payments equal to the price. Now, in the previous clip, we asked, is the yield to maturity a good measure of holding period return? For a zero coupon bond, the answer is yes, as long as you hold the bond to maturity. What about for a coupon bond? Let's think a little bit about the holding period return on a coupon bond. So let's go back to the case where our maturity of the bond is 4 years. The yield to maturity is 8%, let's say. The face value is $1,000. Let's make life simple for ourselves and say that the coupon rate is $80, which, by the way, means, or I should say the coupon payment is $80, which means the coupon rate is 8%, and so the bond sells at par. Let's say we hold the bond to maturity. What's the holding period return? So that means we're holding this bond for 4 years. We're looking for V4 over V0 to the 1 over T minus 1. Okay, so that's, I don't know, what's V4? Well, V0, we bought it for $1,000. T is 4. But what's question mark? What's V4? Well, wait a second. Let's think about this. What should V4 be? Is V4 $1,000? No, because you got the coupons. Well, okay, let's put in the coupon payments. There's 4 of them. Well, wait a second. This is not right either. After all, some of these coupon payments were received at different times. I mean, isn't there something like the time value of money? Couldn't we have reinvested the coupon payments? So this is not as bad as this, but it's still wrong because it assumes we did not reinvest the coupons. What is the right answer? Well, it depends on what we reinvested the coupons at. Now, here's a reasonable assumption. Now, notice I said reasonable, not perfect. A reasonable assumption is that we reinvested the coupons at the yield to maturity. So the coupon that we received in year 3, we reinvested at 8%, and that became not $80, but $86.40. The coupon we received in year 2, well, now we have 2 years to reinvest this at 8%. So this becomes $93.31. The coupon we received in year 1, that becomes $100.78. Adding it all up, we get $1,300.60.49. Reinvesting at 8%, our holding period return equals 1360.49 over 1,000 to the 1 over 4 minus 1. We recover 8%, which was our yield to maturity. This is a general result. For a coupon bond, YTM equals holding period return if the bond is held to maturity and the coupons are reinvested at the yield to maturity. You may not be able to reinvest the coupons at the yield to maturity because yields might change. So for a coupon bond, unless your need for cash exactly matches the coupons, you face reinvestment risk. If you reinvest at less than the yield to maturity, it will be no surprise, and the notes have some calculations, that the holding period return is less than the yield to maturity. If you get lucky, greater than the yield to maturity, then of course the holding period return will be greater than the yield to maturity. So in the case of a coupon bond, the yield to maturity is a flawed yardstick because there's no way to guarantee that you're going to get this. This concept doesn't only apply to coupon bonds. It applies in another scenario where the yield to maturity reappears in a somewhat unexpected way. So the yield to maturity is in fact similar to the notion of the internal rate of return. And the main problem with the internal rate of return is actually the same as the problem that we see for the yield to maturity for coupon bonds. So there's one more complication to think about, and that is the fact that corporations and the U.S. government don't issue annual bonds, they issue semi-annual bonds. So a semi-annual bond has cash flows that look like this. The first cash flow you receive 6 months after you buy the bond. And the way semi-annual bonds are quoted, they don't quote you the semi-annual coupon, they quote you an annual coupon. So in the first 6 months, you receive the coupon divided by 2. After the next 6 months, you receive the coupon divided by 2. At a year and 6 months, you receive the coupon divided by 2. And so on and so forth, every 6 months until the maturity, when you receive the face value plus the coupon divided by 2. Now, to make everything even and to work out really nicely, the yield to maturity on a semi-annual bond is a stated annual interest rate. So the price is C over 2 divided by 1 plus RA over 2. Remember that we use the notation RA to denote a stated annual interest rate. So this is the first payment, which is at the 6-month mark. This is the second payment, which is at the 1-year mark. And the third payment, 1 year and 6 months. And so on and so forth. The last payment, which we raise the 1 plus RA over 2 to the 2t. Notice that for each of these pieces, we are doing what is in effect an effective annual rate calculation. The effective annual rate for this bond is 1 plus RA over 2 squared minus 1. So it's as if there's a little effective annual rate calculation happening at each of these pieces. So we're just going to do one example, just to be super crystal clear. Example, semi-annual bond, coupon rate of 8%, yield to maturity of 8%, maturity of 10 years, selling for a face value of $1,000. The price of this bond is equal to 40 over 1.04 plus 40 over 1.04 squared plus 40 over 1.04 cubed plus plus 1040 over 1.04 to the 20. So notice here, the yield to maturity is a stated annual interest rate of 8%. My period rate is my stated annual interest rate over 2. The period is 2. That's 4%. Now, the effective annual rate on this bond is 1.04 squared minus 1, which is 8.16%. Now, why do we go through this whole mess of stating the yield to maturity as a stated annual interest rate? Well, it has one very desirable feature. If you stare at this formula long enough, you'll notice that you really couldn't tell the difference between this, a semi-annual bond with a yield to maturity of 8%, coupon rate of 8%, and a maturity of 10 years, and an annual bond with a yield to maturity of 4% and a coupon rate of 4% and a maturity of 20 years. They actually look the same. They're what you might call isomorphic. And so all the nice relations that we had for an annual bond continue to be true for a semi-annual bond. Namely, for a semi-annual bond, the price is equal to the face value if and only if the yield to maturity equals the coupon rate. A statement that would only be true if the yield to maturity was quoted as a stated annual interest rate. We have our other relations too. The bond sells at a premium if the yield to maturity is less than the coupon rate, and the bond sells at a discount if the yield to maturity is greater than the coupon rate. Same as for an annual bond. And that's it for semi-annual bonds. So when we talked about present value, we assumed that there was a single interest rate that we could use to discount cash flows regardless of the period. So now we're going to talk about whether that assumption actually makes sense. So one way to think about whether that assumption makes sense is to think about what is the yield to maturity on bonds. The yield to maturity on bonds of different maturities tell us what the market is using to discount cash flows of different periods. So the way that the discount rate relates to the maturity of the cash flow is sometimes called the yield curve. So the yield curve graphically depicts the relation between the yield to maturity and the bond maturity. So you can actually get this from bonds in the data. So here's what we normally do. We take a selection of bonds and we look at their yield to maturity. So currently, if you look at very short-term bonds, at the time of this filming, the very short-term bonds have yields to maturity of about 2%, rising for the longest term bonds to a yield to maturity of about 3%. Now, to construct this yield curve, only certain maturities are used. These tend to be the 1 month, 3 month, 6 month, Treasury bills. By the way, a Treasury bill is a short-term, zero coupon bond, and the 2, 3, 5, 10, and 30-year bonds. Now you might ask, why these maturities? Because after all, we know that there are lots of maturities. For example, last year's 30-year bond is now a 29-year bond. But the 29-year bond is almost never shown on the yield curve, nor is the 28-year bond, nor is the 27-year bond, nor is the 26-year bond, and so on and so forth. Why is that? Well, that's because the newly issued Treasury bonds are the ones that trade the most. They are the most liquid, and so their prices are the most reliable. The name for the bonds that are just issued is on the run. So the most recently issued bonds, the ones with these maturities, are on the run bonds, and the other bonds are off the run. So the yield curve is typically constructed with on the run bonds. The yield curve that I just showed you was upward sloping. Most of the time, the yield curve is upward sloping. But sometimes it flattens. So here is a yield curve that is less upward sloping than the yield curve up here. So people talk about this as the flattening of the yield curve. Hypothetically, you could have a completely flat yield curve. I highlight this because this was our assumption for the clip for present value. When we use the same R to discount cash flows of different maturities, we are implicitly assuming a flat yield curve. A yield curve need not be upward sloping or flat. Sometimes the yield curve inverts. And sometimes it could just be weird. So it could be hump-shaped or inverted, hump-shaped. Here's what we know about the yield curve. Most of the time, the yield curve is upward sloping. That is, we see higher yields for longer maturity bonds. Here's what else we know about the yield curve. When the yield curve looks like this, when it inverts, yikes. An inverted yield curve often predicts recessions. So you might ask, why? Why is the yield curve upward sloping most of the time? Note that this does not have to do with the time value of money, because this already adjusts for the time value of money. That's in the definition of R. Why should it be that the time value of money is more, even adjusting for the length of time, for longer term investments? So the question is, why does the yield curve upward slope most of the time? Another question is, why does an inverted yield curve predict recessions? And the answer is, we don't know. We don't know the answer to these very basic questions. Hopefully, someday we will discover the answer. In the meantime, let's talk about how we might use information from the yield curve to calculate, say, net present value. Let's do an example. An investment costs $1 million. It will pay $0.1 million in 1 year, $0.35 million in 2 years, and 0.6 million in 3 years. So in other words, we have minus 1 million, then 0.1, then 0.35, and then 0.6. Now we also have the following information. We know that for 0 coupon bonds, so the yield to maturity on the 1 year equals 1%. The yield to maturity on the 2 year equals 1.5%. The yield to maturity on the 3 year equals 4%. So the correct thing to do is to calculate our present value using these yields to maturity. So the net present value is our initial cash flow plus the 0.1 we get in 1 year, discounted at the 1 year rate, the 0.35 we get in 2 years, discounted at the 2 year rate, squared, because it's 2 years. The 0.6 we get in 3 years, discounted at the 4 year rate, cubed. This, by the way, is minus 0.028, less than 0. By the NPV rule, we should reject the investment. So that's an example of how you might use the yield curve. Let's do one more example. Suppose you have the following data on 0 coupon bond prices. And these are prices per $100 of face value. The 1 year bond sells for a price of $93.46. The 2 year bond sells for a price of $89 even. And the 3 year bond sells for a price of $83.96. Given this setup, what is the price of a 3 year coupon bond with C over F of 5% per $100 of face value? So what we want to do is value something with the following cash flows. 1 year from now, we get $5. 2 years, we get $5. 3 years, we get $105. So there are 2 ways to answer this question. One way is to back out the yield to maturities from the prices of the 0 coupon bond and discount the cash flows of the coupon bonds at those yields to maturity. So for example, given that P1 is 93.46, the yield to maturity on this bond is 100 over 93.46 minus 1, or 7%. Given that P2 is 89, the yield to maturity on this bond is 100 over 89. Using the formula, the 1/2 minus 1, that's 6%. P3 is 83.96. The yield to maturity is 100 over 83.96 to the 1/3, and that's also 6%. So we can now use those yields to maturity to determine the price of our coupon bond. So 5, now we're going to use yield to maturity 1 plus 5, yield to maturity 2 plus 105, yield to maturity 3 equals 5 over 1.07 plus 5 over 1.06 squared plus 105 over 1.06 cubed, which, by the way, equals $97.28. So that's one way to solve the problem. But there's also a much faster way. We can use the prices themselves. So remember, the price of the 1-year bond per $100 of par value is $93.46. The price of the 2-year bond per $100 of par value is $89. The price of the 3-year bond per $100 was $83.96. Now, suppose you were to buy not a $100 bond, but a $1 bond. The price of that bond would be this price divided by 100, so it would be 0.9346. So if we had a $1 bond, the price would be 0.9346. And similarly, if we had a $1 bond, the price would be 0.89. Do you see what I did? I divided these by 100. If we had a $1 bond, the price would be 0.8396. So in other words, if you're willing to pay $93.46 to have $100 1 year from now, you would be willing to pay $0.9346 to have $1 1 year from now. So now let's take seriously what I said before about these bonds being the basic building blocks. Another way to value the coupon bond is to take each of the cash flows and multiply it by the $1 bond price. So what is my coupon bond? Well, it's a basket. And in the basket are 5 of the 1-year $1 bonds and 5 of the 2-year $1 bonds and 105 of the 3-year $1 bonds. Of course, if I calculate it this way, I get the same price as I got before, $97.28. Except here, I'm using the prices of the bonds. I'm not going through the yield to maturity.